Okay, this is chapter 9. So in this chapter, we will discuss about the additional issues in inventories. Okay, so let's see what we have. We have subsequent measurement of inventories. Okay, then we have to consider the lower of cost or net realizable value, lower of cost or market, then usual method versus gross profit method, and we have last in first out retail method. Okay, so subsequent measurement of inventory is needed because when we purchase or produce inventories, so after the production of or purchase, the inventory may be damaged. So sometimes we have the physical deterioration, obsolescence, because you think about the iPhone 12 is already in the market, so iPhone 4 is definitely obsoleted. So the price of the iPhone 4 has dramatically uh, decreased, and the change in price level. So due to all of these, the ability of the seller is reduced. Okay, and gap requires that companies evaluate their unsold inventory at the end of each reporting period. It may be uh, in every quarter or annually. Okay, so there are two different approaches to inventory write down. So let's see the say the when the expected benefit of unsold inventory is estimated to have fallen below the cost. See, the companies must make an adjusting entry, which is called inventory write down, and it will reduce the inventory and net income for the period. So which measurement approach you will use, it depends on which uh, inventory costing method we follow. So if we follow the first in first out or average cost, okay, but we are not following the last in first out, then we will be using the lower of cost or net realizable value measurement approach, and the impact will be it will reduce the reported inventory and reduce the net income. And if we follow the last in first out, okay, we will be using the lower of cost or market. And net realizable value is equal to selling price minus cost to sales. Okay, and see if the net realizable value is lower than cost, meaning if the net realizable value is lower than cost, we need to prepare an adjusting entry. Okay, if it is common, just remember that if it is a common phenomenon, then we will record cost of goods sold debit and inventory credit. But if the opposite is true, that net realizable value is more than cost, okay, then we don't need any adjusting entry. Okay, let's see an example. See, from this example we can see we have different items. Okay, A, B, C, D, E. So we will report the lower of these two values from cost and net realizable value. We are given the NRV, so we don't need to calculate. So we can see that for item A, the cost is 50,000 and NRV is 85. Which one is should be reported? So 50,000, the lower one, correct? So for B, 100,000 cost and 90,000 NRV. Which one should be reported? 90,000. Okay. So the same way, all of this. Okay. And now, if we look at the total by individual item, 395, and now we have 415,000. So the difference between these two is 20,000. So, and we can see that here the net so lower of cost or NRV is less than the cost. Okay, so the difference is 20,000. So we will prepare the adjusting entry for this 20,000. Okay, So here is the adjusting entry. See the cost of goods sold and debit and inventory credit, because we are assuming that the write down is common for this particular company. But if the write down is not common, then we will debit loss, okay, instead of cost of goods sold. And the difference between US GAAP and IFRS in case of lower cost or NRV is US GAAP does not permit the reversal of this one. Meaning, once you report the lower of cost or net realizable value, you cannot reverse it. But in case of International Financial Reporting Standard, if circumstances indicate that an inventory write down is no longer appropriate, it must be reversed. Okay, and you can report by individual item or by categories or by entire inventory, total inventory under the US GAAP. But under IFRS, so you can use say individual items by individual item, and in some circumstances the reporting by category is allowed. Okay, so now let's solve two problems. Okay, so here are the problems that we will be solving. So the problem set is already on Learn, so you can download them and practice with me. So we have this problem, and this problem is telling us, so the inventory of Royal Decking consisted of 5 products and the information are below. So the product ABCDE and the cost, and say we are given the selling price, so we need to calculate the NRV, net realizable value. Then we can compare with cost and NRV. So the cost to sales is 10% of selling price and 5% of cost. So now the question is, what unit value should be reported if we follow the lower of cost or net realizable value? Okay, so our first step is calculate the NRV. Okay, it should be easy. See, NRV is equal to selling price, so I'm taking the selling price minus 10% of selling price. So again, selling price multiplied by 10%, okay, minus 5% of cost. So this is our cost, so 5% of cost, sorry, 5% of cost, okay. So this one, if we just double click on this small square, the formula will be copied to other rows. Okay, so now you can see that we have calculated the net realizable value. So now our second step is to calculate the lower of cost or NRV. So we have 40 and 50. Out of these two, we will report the 40. So in Excel, there is a formula mean. So we will take the mean of these two. So see that out of 40 and 52, minimum is 40. So 40, we have taken 40. So copy the formula. So this is how we report. Okay, this is the answer, final answer of this one. And now for problem number 2, this is for your practice actually, but even after that I am showing you how to solve this one. Okay, so this is just a copy of all of these information, product, cost and total net realizable value we have already been given. So we need to just use the formula of the minimum one. So minimum of these two would be, say that out of 120 and 100, so we have taken 100. Okay, now we will do the auto sum 270, and we will do the auto sum of this. So the inventory value is 270. Okay, but the cost is 300. So the difference between inventory value and 300 is this one, meaning 300 minus 270 is 30,000. So we need to prepare adjusting entries for this one, for this write down. So the adjusting entry would be, so cost of goods sold debit and inventory credit. So 30,000, 30,000. Okay. This one is easy, and the third one, this one is also easy, but this is just by category and by total units. Okay. So the company sells two product categories: tools and paint products. The information related to year-end inventory, say tools. Okay, we have hammers, saws, screwdrivers, and paint products. We have, so 1 gallon cans, paint brushes. So these are the informations we have. The quantity, the per unit cost, and net realizable value are given. So we need to determine the carrying value of inventory at year end. Okay, so here it is. So this, here is the solution. So what we will do here, see, this is just a copy of this table. Okay, this table is just has been copied over here. So now we need to calculate the lower of cost and NRV. So the same thing, minimum of these two. Sorry, there is something wrong in the formula. So okay, minimum, see, out of 500 and 550, 500. So this one, the same thing over here, minimum of these two, lower of these two values. Okay, so let's see the total of all of these. So this one is 5,800. So let's just copy this one over here. Okay, this. 5,800. So now by product type. So by product type, we have these two values. So what we can do, we will take the lower of these two, the lower one of these two. So, and here the same thing. So minimum of the main value of these two, correct? So our total for byproduct is gonna be this one, 6,050, and by total inventory, see, I will calculate based on the cost and NRB. So 6,500 and this one. So this one should be minimum of these two values, correct? So this, and now we need to prepare the journal entries in the adjusting entries. See, the by individual product is the 700. So cost of goods sold and inventory. Okay, 700. So I'm just copying this one because we'll be writing the same thing for all of these. So cost of goods sold and inventory. So here 450 we have calculated. So 450, and here it is 420 and 420. Okay, this is all in this part.